What is going on, guys? Today I'm going to give you my method of scanning for stocks, how I find them, what I look for to keep on my watch list. So let's dive right into it. The first is value. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. The higher you pay, the lower the return will be. That's a big thing for me. I put it right on my Twitter bio. It's the first thing. I'm a value investor. I'm never going to overpay for something. I want to be very patient and make sure that I'm seeing value in the companies that I'm going to put my money towards. Successful investments, industries that are most likely to grow in the future, and then identifying the most promising companies in these industries. So my top sectors are AI, robotics, genomics, blockchain technology, cybersecurity, and energy storage.
Right now, we see the S&P is comprised mainly of retail companies. I believe in the next decade or two, you will see these sectors kick retail out or replace them in these major indices like the S&P 500. We're looking for the future. We're looking for the growth. I believe these six sectors are where the future is going.
So, important information: obvious prospects for physical growth in a business does not translate to obvious profits for investors. Please understand that. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. So you see your experts, you see your mainstream media analysts, you see even guys like Melvin Capital, Archegos, that get blown up. Jim Cramer, these guys do not know how to pick stocks clearly. So just because they're smart money, just because they manage billions of dollars in assets, just because they have Ivy League school degrees does not translate to profits for them. Okay. You could be the smartest person in the world. That doesn't mean you're going to be a good investor. So, how does the company plan on growing? We want to see that they're expanding their operations or possibly even see what subsidiary companies they own. Are they acquiring new businesses? Do they have a revolutionary product or products? Amazon, for example, they're not just selling products online, they're acquiring other businesses like MGM, for example. AMC, it's a dying business, right? Movie theater business is not going to be sustainable in the next 10, 20, 30 years. Okay. Streaming and other methods are going to be more popular, and they already are. So they have to expand and go into different sectors if they want to continue to have this stream of income. So they going into the precious metals business, crypto, NFT, and even the wholesale business to where they're going to sell popcorn, which is on high margins. So the point is, no matter what company is, you want to see that they're diversifying and they're looking for the future and they're seeing other methods that they can have or provide that income for their business. So, is the company profitable or are they anticipating future profitability? This is important because Tesla, for a long time, did not make any money. Up until 2020, they were not profitable. Year after year, they were losing money. So, like many companies, people believe in the future of a startup in hopes that management is strong and will grow the company successfully. Take a look at Tesla right here. We saw 2018, 2019, they did not have positive cash flow. But finally in 2020, 2021, and now look at how quick they're compounding those earnings. And we're seeing vehicle sales go to all-time highs. So that is the point. If you bought Tesla a year ago, even back in 2018 or 2019, look at how well you're doing with a company that wasn't earning anything. Social sentiment, what the public or social media is interested in. This is going to be very important. What people are talking about, high volume, more transactions, more interest. So we want a play that is very active and that people are talking about. Okay, so let's just take a dive back into history. So going back within basically 2 year time frame, so March of 2020 to where we are now, we saw the explosion of shit coins, the weed sector like Canopy Growth, JMIA, the Tilray merge. Then it became penny stocks, healthcare sector and genomics like BNGO, SENS, JAGX, Tiva, Ocugen. EV sector became Lucid, Neo, Rivian, the merger of CCIV until what we saw now, even MULN. Tech was huge. Okay, it blew up. Square, Block, all those companies, AMD, Apple, Facebook. And now we're in the meme stock era. So, it's these highly shorted companies, low cap stocks, and that's what people are focused on, low float. So social sentiment, very important because these trends or these hot sectors, they bounce around in time. They're like fads. Float's pretty important because companies with a smaller float are able to achieve a greater potential in share price due to the overall supply of shares that exist in the open market. So, taking a look at the most expensive stocks that are trading currently on the market, go take a look at their float. They're all very low, or to some extent, relatively low due to how high the share price is. That is a key, okay, especially Berkshire, NVR, SEB, BKNG, AZO, very, very low float. And even what we saw in GME, why it was able to have such an aggressive rip is because the float was low. So less dilution is key, but sometimes it is essential for companies to raise capital through share offerings. And hopefully in the future, you could see those shares or buybacks that happen from the company. So Apple would be a horrible example, 16.9 billion, I believe, in the float. Not a company I like technically or moving forward, but that is an example of something I would stay away from. 3 elements of investing. So this is Benjamin Graham. You must thoroughly analyze the company and the stock soundness of its underlying business before you buy the stock. Hence, underlying business, please. You must deliberately protect your investment against serious losses. A guy like Warren Buffett is so successful, not because he cares about how much he's making, but how little he's losing. Okay, let me say that again. He doesn't care about how much profit he's making. He cares about how little he's losing. Okay, minimize your risk, minimize your losses. Okay, you must also aspire to adequate, not extraordinary performance. So, still taking profits, securing your money. Profits are profits in the end. Maybe it's not what you want it to be, but still you're coming out green, you're coming out successful. That's very important. So, some wise words. Stocks do well or poorly in the future because of the business behind them that does well or poorly. Nothing more, nothing less. You must never delude yourself into thinking that you're investing when you're speculating. Speculating becomes mortally dangerous the moment you begin to take it seriously. You must put strict limits on the amount you are willing to wager. It's important again. We don't want to YOLO everything. We don't want to invest what we cannot afford to lose. And last, everyone believes that they have the golden method or golden investment strategy. So to recap, this is important here. So just listen to the end. Value, undervalued versus overvalued. Are you paying a good price for the current stock at its valuation? Don't trust the experts or analyst picks. Make sure management is wise and experienced. You don't want fraud. You don't want shady things tied to them. Make sure you do your research. Look for strong companies in growing industries. Volume, no less than a few million per day on average. You want to be able to get in and out of your trade successfully. You don't want stagnant periods in the market. If for some, emergency reason you have to sell your position and get out and there's no volume and it's a dead day and you're not able to sell, your order is not getting filled. So volume is important, but also kind of ties to social sentiment that you want people to actively be trading within the ticker. Lower float is ideal, less dilution, greater potential, especially to have those moves up. And then never invest in speculation, never invest in something you don't understand, never invest just solely off of one person's opinion. That should be at the top. But anyways, that is what I have for you. I hope you guys have enjoyed this video. I do appreciate you sticking to the end. If you enjoyed it, drop a comment below and tell me what tickers you're following in the future or which ones you're planning on investing in. And as always, we'll see you in the next one.